Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. Joining us for this segment, we have William Huston, Founder and Chief Investment Officer at Bay Street Capital Holdings, a provider of investment advisory, wealth management, and financial planning services, to discuss why investors should consider illiquid asset classes that are uncorrelated to the stock market, such as real estate. William, it's great to have you with us. Welcome to Trade Talks.
You too. Thanks for having me.
In an environment with rising interest rates and high inflation, it's important to consider illiquid asset classes that are uncorrelated to the stock market, like real estate. Explain to us why.
Very important. Again, right now, our U.S. stock market, there's a lot of big things that are moving that as well. So we've seen the rise in energy prices in Europe. The U.S. S&P 500, 30% of revenue comes from Europe, right? So when you've got a situation where prices are going out of control in Europe, that is going to affect U.S. equities. And when you purchase non-correlated assets, you're not going to be as affected by the U.S. equities if you're holding a traditional, all equity portfolio in the U.S. or like a 60-40, something like that. That's also why the 60-40 portfolio has not performed as well as it could, or I think most investors were expecting, because it is tied to a lot of other things that are very correlated to the market. So inflation is going to remain high. The Federal Reserve is going to continue raising rates over the next several months. The market's looking at how that rate increase is going to happen from a pace standpoint. But luxury real estate is actually very interesting for the investor that's looking to be active in these properties and replace a lot of absentee landlords that haven't put as much effort into getting additional revenue out of the properties.
It's interesting too, when you look at both the asset classes, even the most basic differences is the stock market is valued day to day, tick to tick, second to second, but real estate is one of those assets that doesn't move like that.
Absolutely. Again, these alternative assets that are not priced on a day-to-day basis, they will prevent a lot of the volatility that investors who have an all equities portfolio are looking at on a day-to-day basis. Also, the luxury space is performing extremely well during this period of inflation. So travel is up 89% year over year. Airfare is up 44%. And even in the eyes of inflation, hotel stays are up 22% year over year. The reason why we're focused on the luxury space in the smaller independent brand properties is because since COVID, those properties have also outperformed from a margin standpoint the core brands like the Marriotts and the Hiltons. And what we've seen even in Marriott's own response to COVID, if you go to their homepage right now, you'll see that they give you the option to stay in a private residence where they partnered with investors to rent out these nicer properties. And again, that is in response to what they've been trying to do to compete with Airbnb, but also in response to what their users have asked for. 90% of the people who are booking on those private residences are existing Marriott users who are preferring to stay in a private hotel or in a private residence as opposed to a larger hotel.
And I think that's one of those trends that are going to be here to stay, because now that we know we can operate remotely, rather than having to take only 1 week, perhaps you can take 2, 3, 4 weeks. I mean, we saw in the beginning of the pandemic, people were using Airbnbs or Marriott properties for an entire season because they were able to do so.
Absolutely. With people doing work from home, with people working remote, with all of the apps that have proliferated in the market where you can DoorDash your food, you can Calm app, you can use any sort of app to get services that are likened to the concierge service at a hotel, all from the safety and the privacy of your own off-market property or even on-market property on like an Airbnb is very attractive to travelers, especially that are traveling in groups or that are traveling with their families, where they'll have more space, they'll have more privacy, and they can also be more particular with location. So if you're looking to be, close to where a lot of things are happening, if the hotel isn't perfectly positioned, it's difficult to move a several hundred room hotel to a better destination, but you can always look at where you're looking to travel and find a very nice property and pay a little bit more on a night-to-night basis.
William, let's talk about the logistics here for a moment. How does one get into this type of investment, and how liquid is it? What if you do need to, if you want to reallocate your positions, or if you just want to get out of it and leverage some cash? How do you get in? How do you get out?
So a lot of investors are holding cash right now. The last 10 years have performed very well for investors. For anyone who rebalanced earlier in the year that has been holding cash looking for opportunities, we typically recommend anywhere from 20 to 25% of their portfolio in these alternative asset classes like like real estate. So for someone who's looking to say, how do I dip into this? They can either go at it on their own and say, I'm going to find something close to my home that I can actually manage, or they can go in with a group of investors or through a fund or something similar where there's a large pool of capital that's looking for these properties. Again, we like the space in the 5 to 7 million, even up to like 10 million purchase price, where it's slightly more than an accredited investor would purchase on their own, right? Where even if they did have a vacation property they were renting out part of the time, you're looking at something that's a little nicer than what you'll find on Airbnb, with less rooms that you would run into with the Hilton. So instead of something that's a 2 or 3 bedroom, looking at something in the 5 to 6 bedroom space. If you're looking at the hotel motel space, something with 2 or 3 floors, as opposed to something larger with several rooms. And what we know from the data is that those properties are going to outperform, especially, again, if you have an active investor who's putting some effort into rebranding that property, turning it into a destination for the audiences that are interested in traveling there, and focusing on location, location, location.
Of course, the mantra throughout real estate in general. And my last question is, I want out, right? Sell the property. If you're with a group of investors, you sell your share to the investors. Is that typically how it would work?
That is. And again, if you focus on location, I don't think that will be a problem. At Bay Street, we closed on a property last month. It was 5.65 in Venice Beach. Venice Beach, second most visited place in Southern California. We got an all cash offer last week for 6 million, right? So again, it's just based on where you are. And this is in a market where, a lot of the news is saying that the real estate market is slowing down. But when you buy an asset in a key area where that there's going to be pent up demand for long periods of time, you don't have to worry about that. We also closed on a hotel in South Lake Tahoe. That was the #1 visited place, according to Zillow, for 2021. So looking at areas like that, where there's only 18 hotels to choose from, one comes up for sale, you're not going to have a difficult time selling that property down the line if it's something that you need to sell, unless some sort of material change comes up. Like, for example, Tahoe catches on fire, it might be difficult to sell a hotel, in that scenario. But otherwise, I think that's how I would be looking at it. Very high quality assets that anybody would want to take off your hands down the line.
Yeah, I would agree with you. I don't think the luxury market's going to be impacted by rates or demand either. Appreciate the insight, William. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.
You too.